Hey guys, welcome back to another video. Today we're going to be talking about debt financing term sheets. So these term sheets are discussion papers that a lender would provide to a business owner that is looking to borrow funds to, buy a piece of real estate, buy a business, whatever the case is. So this document is very common. The structure of the document, while there may be section differences, the overall wording and the concepts behind this video are universal across any term sheets that you would come across when borrowing money from banks. So this video is really dedicated for business owners that want to understand term sheets, as well as commercial bankers that are new to the sector and want to understand the document a little bit more in depth. So I know there's a lot of detail here. Just as a quick background, if you've never watched one of my videos before, I started my career in the commercial banking world and transitioned into the M&A mergers and acquisitions world now. But I try to share my experience in the commercial banking world to help everyone understand the concepts and these types of documents. So if you find the video helpful, please do like and subscribe to the channel, as it takes quite a lot of work to to build these videos. But let's get started. So right away at the top, you'll see that there's always going to be a disclaimer that indicates that a term sheet is conditional upon credit approval. The investment committee, the credit committee of the bank that signs off on any loan application is going to need to approve these terms. So the person that you're dealing with at the bank is usually the relationship manager, the credit officer. That is really the sales agent, is structuring the deal, providing the terms, giving you a broad range, and is going to put this in this term sheet. Now, you're going to sign back this term sheet, at which point in time they're going to begin doing in-depth analysis on your loan application and then submitting that loan application to the credit committee. Now, good bankers, the terms that they'll put in the term sheet usually translate to what gets approved by credit. Aggressive bankers or inexperienced bankers may overpromise and underdeliver, unfortunately. So sometimes the terms that you'll see in the term sheet are not actually the terms that actually get signed off on by credit. So if you have a risky deal or there's, a deal that, there's a bit of gray area, there's a bit of fuzziness, expect that some of these terms may not actually translate. But at the end of the day, this is really the starting point of the negotiation between the business and the bank. Now, obviously, whatever the currency is, so whether it's Canadian or U.S. bank, the currency will be clarified. The date, obviously, then there's the lender. So this line indicates the legal entity that is giving you the money. So if it's Scotiabank Inc., TD Bank Financial Inc., whatever the case is, that is the legal entity. And then on the flip side, who is the borrower? Who is actually receiving the funds and borrowing that money? And in most instances, what ends up happening is, say, for example, you have a holding company that owns the piece of real estate and you want to borrow a mortgage. Well, the holding company would be put as the borrower, and then the guarantor would be the actual operating entity that guarantees the mortgage and supports the financing and paying back that mortgage. Now, in other instances, if it's the operating business borrowing funds to fund equipment or to fund working capital, then really the borrower would be the actual operating company, and there may not be a guarantor in terms of a corporate guarantor. So the borrower and the guarantor are really important because these sections clarify where does the loan reside, and where the loan resides is the borrower. That's the end user of the funds, and then the guarantors. The debt does not reside on their financial statements. Rather, that is really they're just providing support. And so, really, as a lender, the way we look at a deal is we group all the cash flow and all the profit and that is used to service that debt by combining the financials of the borrower and all the guarantors that are related in that deal. So there's sometimes what we call ring fencing, and in most instances, if a corporate entity is borrowing the funds, we will, the borrower will be the corporate entity, but then we'll get all the holding companies that are around and related to that operating company to be guarantors, so that we're ring fencing all of the related entities so that everyone is committed, all these corporate entities are committed to repaying that debt. So most banks are very, very cognizant of your corporate structure. And that's why they spend a lot of time understanding, okay, who's generating cash, who's just a holding company, and then making sure that they're ring fencing everything. So funny enough, these two lines are actually very important from a lender's point of view. The next section is a sources and uses table. And this really breaks down the loans that you're going to be borrowing from the bank and what it's being used for. So the sources of funds for the transaction, and then the uses of the funds are where they end up going. And so in this instance here, this is an M&A loan. So the situation is that company ABC Inc. is going to acquire 100% of the equity of XYZ Inc. for $20 million. In addition, there's about $300,000 in costs associated with the loan. So really the uses, the end product is it's about a $20.3 million deal. Now, the bank is going to be, now going to the sources, the bank is going to be putting in $15 million in senior debt. The owner of ABC Inc. is putting in $3.2 million in cash equity. And then the balance is a vendor note, so it's a seller note from XYZ Inc. to ABC Inc. of $2 million, which would be deferred to the senior lender. And so the 15 plus 3.2 plus 2 gets you your 20.3. So this visually explains the transaction and confirms how the bank is going to be funding a portion of this deal. Now, as a lender, a key consideration for us is always how much skin is in the game. So if we're giving you $15 million and the deal is 20.3, how much of that is being funded through debt versus your own equity? And so let me just take my handy dandy calculator here on my desk. So $15 million divided by 20.3 is 73% of the deal. So usually, I would say banks like to see kind of that 60 to 80% of the deal being funded in senior debt, with the balance coming from equity or deferred equity. So the balance of the 3.2 divided by the 20.3 means that this owner is putting in about 16% equity in the deal. And then the postponed vendor note, so long as it's subordinated to the bank, is also seen as equity. So that's seen as deferred equity. So really, there's 73% debt from the bank, and there's 28% in equity and deferred equity in the deal. So from a risk point of view, there's a lot of skin in the game. There's a lot of capital behind the bank going into the deal. Now, the worst case scenario, say for example, it's a $20 million deal and a borrower is looking to borrow the full $20 million. The challenge with that is the bank is not seeing skin in the game. You're not putting any money up. So if this deal goes sideways, we bear the full risk and you can just walk away and not lose any equity funds that you've put into the deal. So the bank is always cognizant of how much equity and postponed vendor notes are in the deal. So now, once you understand the sources and uses table, we go down to the facility. So in this term sheet, there's only one loan facility. There may be multiple loans. There may be a real estate equipment cash flow loan. There may be an operating line. There may be multiple things. So these facilities, there may be term loan 1, term loan 2, term loan 3. But for this term sheet, there's only one. It's a $15 million senior term loan. Now, it breaks it down based on the key terms of that loan. So the loan amount is 15. The interest rate will bear BA plus 2.5%. And so what this means is that this is the banker's acceptance rate. This is the cost of funds for the bank plus a spread that they're marking up to you. So they're borrowing the funds at BA, and then they're lending it out to you at BA plus 2.5%. So in this instance, this is a floating rate loan. A fixed rate loan, it's really all you'd really see is it would be a 4.75 or a 5% loan. Here, it's a floating rate loan, meaning that as the BA goes up or down, the interest rate on your loan gets reset up or down based on the 2.5% spread. So if you see a BA plus 2.5%, this typically indicates that it's a floating rate loan. If it's just one percentage number, then it's a fixed rate loan. And sometimes they'll even say fixed rate floating rate loan. And so the next section here is on an annual basis, the rate will be updated to account for the below pricing. So what some banks do is they will price a loan according to leverage or performance based on certain covenants. And then on an annual basis, if the performance of that business improves and the covenants strengthen, then the rate goes down to reflect the decline in risk. And then if the business begins to underperform, the covenants, decline and weaken, then the rate increases to account for that increase in the risk of the business. So sometimes you will see an interest rate and it will just be this section, and this grid below will not be there, whereas other bankers, they're more progressive and they'll give you the variability based on performance. So in this one, and I'm using a past deal here that I did when I was in the lending world, we would always reward our clients because it was a way to be competitive as the bank, to say, hey, listen, other banks are giving you just one rate. What we can do is we can give you a grid. And so if you perform better, then our cost of funds actually become lower than what you would borrow on just another single interest rate relationship. So in this instance, we're pricing the deal based on leverage. So it's senior debt divided by EBITDA, the cash flow of the business. So if the senior debt divided by the EBITDA is less than 2 times, meaning that it's very low leverage relative to the earnings of the business, then the banker's acceptance rate plus a spread of 1.75% is much lower than the starting first-year interest rate of a spread of 2.5%. And same thing, if it lands between 2.75 and 3.25, then the rate declines by 25 basis points, 50 basis points, 75 basis points. So here it's a declining grid scale based on paying down the senior debt relative to maintaining a consistent level of EBITDA, or the EBITDA growing relative to the leverage. So hopefully that makes sense. The next section is the term. So in most instances, for business loans, you will see terms of anywhere from 3 to 7 years. In Canada, a lot of banks don't like to give terms longer than 5 years. So the Canadian banks kind of land within that 3 to 5 year term. And the difference between a term and an amortization is that the term is really the length of the loan, whereas the amortization is the period of time that it takes to pay down the loan fully. So I may have a 5-year term, but I have an 8-year amortization. The amortization means that over 8 years, I fully pay down that loan, but really the loan is only for 5 years. So what ends up happening is after 5 years, there may be a balloon, a little bit left that hasn't been paid down yet. And so that either gets refinanced or gets paid out fully by the business. So that's why term and amortization are different. The term is really the length of the contractual relationship, the period of time in which the loan is outstanding, whereas the repayment is how do you repay the loan, which actually may be longer than the term. So in this instance, the repayment, the term loan will amortize monthly, beginning the first full month post advancing the funds, and will amortize for, in this example, 8 years. So that means that this $15 million loan, and simple math would say $15 million divided by 8 gives you $1.875 million. So every single year, you're paying down $1.875 million. Now, if the term is 5 years, so I multiplied that by 5, that means that at the end of the 5 years, I've paid $9.3 million of the 15. So really, the $15 million, I have $5.6 million left at the end of 5 years. That's now a balloon. And what ends up happening is either the business will pay that fully, which rarely happens, or they just go back to the bank and they refinance and extend the loan for another 5 years at the same amortization until it's fully paid out. Or they may borrow more and re-leverage the business if required. But in this example, it clearly clarifies the number of years that it amortizes. Sometimes the bank will give you number of years. Sometimes they'll give you number of months. I've seen examples where it amortizes over 60 months. So what you do then is you take the months, divide that by 12, and that gives you the number of years, just so that you can more simply think through what is the yearly pay down relative to the term of the loan. And then lastly, sometimes the term sheets will actually show you the scheduled monthly principal repayments. So just to quickly go through this once again, a $15 million loan divided by 8 years is 1.875, divided by 12 months. In this example, it would be $156,250 would be the monthly amortization for the loan. Now, most loans have early repayment clauses. And what that means is that you can repay the loan if you have excess funds more quickly than the amortization. But the bank doesn't want you to pay too much down too quickly, because they've gone through the whole ordeal of lending this money to you, incurring these costs. They've deployed the money at a profitable spread for them, so they don't want you to fully pay back that loan a year from now. They want it to be fully deployed. So what they give you is they give you some early repayment opportunities, but anything beyond that is charged at a penalty. So as you can see here, the loan cannot be repaid in the first 6 months from the date of closing. So the first 6 months, even if you have the funds lying around, we're making our full spread as scheduled and as planned. But thereafter, the borrower can repay the loan and any outstanding interest up, at any time. But if you wanted to pay back this entire loan, outside of what's allowed, there's a 6-month interest penalty. So the best way to think about this is I have a $10 million loan. I've paid down $1 million. I have $9 million left. So that $9 million, I'm unable to prepay without a penalty. So really, if I wanted to pay, I could pay a penalty on that $9 million, which is essentially 6 months of interest on that $9 million of not allowed prepaid outstanding amount. So that's the best way to think about it. But usually around 10 to 15% of the annual outstanding loan balance would be allowed to be prepaid without any penalty. So in this example, let's go back and just assume day one, okay? Let's ignore the first sentence here. Let's say, day one, you're thinking about prepaying that $15 million. Well, you're allowed 10% or $1.5 million of that 15 to prepay the principal without any penalty. So now I have 13.5 left. But now the balance of that 13.5, if I wanted to pay it day one, I would have to incur 6 months of interest on that 13.5. So I would multiply BA plus 2.5%, multiply by 13.5, gives me my annual, divide that by 2 to give me 6 months of interest, and that's really the penalty that I'd be paying. And that is substantial. It could be $100,000, $200,000 in prepayment penalties. So a lot of business owners need to be cognizant of how much that is. Usually I see this range from 3 to 6 months of interest penalty, and this from 10 to 15%. So going down to the next section is a security. So security is really important because, again, what is the bank taking as security? Usually banks want as much as they can get, whereas the business owner wants to protect as much as they can get so that, in a worst case scenario, they don't lose everything. So let's go through the common security agreements. So the first is a registered general security agreement or other documentation as required to register against the equipment, the business, the asset that's being lent to, providing the lender with a first, fixed, and floating charges over all assets of the borrower and guarantors, subject to permitted encumbrances to be agreed upon. So that's a lot. So I remember when I first started, I didn't understand this. I'd put this term sheet out and I could not explain it to the client. So let's break it down. So the general security agreement is essentially an overarching security document that a borrower and a guarantor signs. And so what you're saying is this GSA charge is placed over all of the assets. And so that's why they're saying a first, fixed, and floating charge over all assets of the borrower and the guarantors. So that GSA charge is an agreement that grabs all security in relation to the borrower and the guarantors. Now, the GSA agreement is good to grab everything, but maybe you as a lender are lending for only one thing. So what may end up happening is that you get a GSA over what you want. And so that is done by registering a security charge against a specific piece of asset, the VIN number. So the VIN number is that vehicle identification number that allows you to identify a piece of equipment, a piece of like vehicle, a car, a truck, whatever the case is. And so there's a central, federal, provincial online database where you can pull up the VIN for that asset and register a lien or a charge against it. And so as the bank, if I'm funding and I'm financing the purchase of a truck, I will register a specific lien against that truck so that you can't go and sell it to someone else or borrow against someone else, because that next person is going to search up in that database. Oh, look, the Bank of FinanceEkid has lent against that truck, and therefore it's their piece of security. So we can't borrow against that piece of asset anymore. So the GSA is the overarching security agreement. The PPSA, or the Personal Property Security Act, which is for the Canadian borrowers, or the Uniform Commercial Code, which is for the US borrowers. These are the acts that register specific charges, whereas the GSA charge is universal. It's across North America, and that's really just a legal document. But, it's really a promise that the business is making contractually to the bank that I'm giving you security over all of my assets. Now, the second here is assignment of business and other insurance policies required by the lender, with the lender to be named as a loss payee on the policies. So what that means is, say, for example, the business has a commercial insurance policy, they have a real estate policy, they have like directors and officers liability insurance, whatever the case is. And so insurance is used to mitigate risk. And if I'm lending against a piece of property and that property, gets burnt to the ground, there's insurance to cover against that. And in that instance, if I'm the lender on that property, I would have first right to make a claim and grab the insurance payout. So it's a contractual document that guarantees that in a scenario where a insurance policy pays out against something that happens, the lender is to be named as a loss payee on the policy, even though the business is actually the policy holder and is paying for the policy. And so long as I am the outstanding lender and you owe me money, in a worst case scenario, if the insurance policy does pay out, I have first security on that policy. So again, it entrenches me as grabbing any sort of funds in a worst case scenario for me to grab as security. Because again, as a lender, I need to be protected. And what some lenders do is they will review the insurance of the existing borrower and say, you are underinsured. So if you want me to lend you money for that mortgage to buy that property, you need to carry this. So they usually require the borrower to have the insurance and then also name themselves as the payee for that insurance for ultimate protection against those black swan events. Now, number 3 is a corporate guarantee. So what the corporate guarantee, it's very similar to the GSA agreement. The GSA agreement is the floating document, whereas the corporate guarantee is the actual dollar amount that the company is guaranteeing. And so the corporate guarantee is the borrower signing for the amount that they borrow. So in this instance, the loan is $15 million. So borrower in this instance is company ABC. So company ABC Inc. would sign a corporate guarantee for $15 million and supported by a GSA agreement providing a first charge over all assets of the guarantors, including a pledge of shares of the borrower and its affiliates. So once again, the corporate guarantee specifies the actual charge against the business based on the outstanding amount of the loan. The GSA is the underlying document that grabs all the assets and all the security for the guarantors and the borrowers. And then here, and includes the pledge of shares. So in addition to signing a GSA with a corporate guarantee, you're also signing over the shares that in a worst case scenario, if you default on the loan, I have priority to take those shares and operate the business as the lender now. And that's what ends up happening. If you default on a loan, lenders have the share pledge, and with that, they have full control over the company because they're now a creditor that's owed and in default, as well as they have a pledge over the shares and can go to court and take full equity ownership of the business. Now, number 4 here is relevant priority and intercreditor agreements. So intercreditor, I kind of talked about this in another video, but an intercreditor agreement is essentially the rules of the sandbox if there are multiple lenders. If there's only one lender, this clause is not required. But say, for example, you've already borrowed money to finance some trucks, and now you've come to me to borrow funds for a mortgage to buy a piece of real estate. Well, the guys that have financed the trucks have a specific VIN number registration. They've registered under the PPSA Act a charge against the trucks. But I am lending to the business to finance the real estate. So really, they have a charge on the trucks, a first position charge on the trucks, and they have a second position charge on everything else because I have a first position charge on everything else. So as a lender, if I'm the big lender in here, I want to charge on everything except for what you specifically need for your loan. And then we agree that in a worst case scenario, if we had to liquidate the business, the guys that finance the trucks would have priority over the funds to liquidate the trucks, but everything else goes to me because I'm the senior lender. So that intercreditor agreement clarifies if there are multiple lenders in the room, who has what seniority in terms of the assets, the shares, and the liquidity value of the business. Okay? Now, number 5 is a personal guarantee. So in most instances, when it's a loan, so in this instance, this is a cash flow loan. I'm financing an acquisition. I'm not financing a piece of real estate where it's $20 million in attributable value, and therefore I don't really need protection against unsecured value. Here, it's an M&A loan. So really, I'm financing the cash flow of the target company. So there's no specific assets to securitize against. So it's really, I'm securitizing against the enterprise value of the business, which is, again, not tangible value that I can go and sell off in a bankruptcy scenario. Therefore, the personal guarantee provides additional security for unsecured loans. You don't usually see personal guarantees as if it's a real estate mortgage, unless you're very highly levered. But if it's a cash flow loan or an M&A loan, usually you do see personal guarantees to, again, ensure that there's skin in the game from the buyer of the business, that they're personally guaranteeing a portion of that loan. Sometimes the personal guarantee is 100% of the loan, $15 million, but I usually see in the current marketplace that PGs are anywhere from 30 to 50% of the loan. So in this instance, this is about a third of the loan. $5 million out of $15 million would be personal guaranteed, and so that would be personally signed. It would be a document that you would personally sign as the shareholder of that business. So while if the company goes bankrupt, there's always that limited liability protection. If you sign a personal guarantee, they can come after your personal assets as well, because there's no limited liability protection against personal guarantees. Now, number 6 is the postponement and subordination agreement between the lender and the holders of the vendor note in the amount of X, on terms and conditions that are acceptable to the lender. No principal or interest payments are permitted without prior lender approval. So that's a lot. Let's break it down. So as you can see in the sources side, there's a postponed vendor note. And so as I talked about, most banks want to see that even the seller of a business in an M&A transaction is maybe providing some deferred financing to the buyer so that they're waiting for a portion of the funds to be repaid after the bank is paid back. So this postponed vendor note of $2 million is essentially a loan from the seller of the business, XYZ Inc., to ABC Inc. for a period of 3 years. And during those 3 years, the loan will not be paid back and it will be interest only for the full 3 years. And at the end of the 3 years, that vendor will now be paid back in full, the $2 million. And so that's seen as deferred equity because the seller is waiting 3 years to get the $2 million back. Now, the postponement and subordination agreement is very similar to the intercreditor agreement with the other lenders. Here, the seller is a lender to the buyer because, again, they're providing financing to the buyer to buy their business, but they're a subordinated lender. And so what the bank wants to see is that the seller signs a postponement and subordination agreement, which defers their claim on assets and subordinates it to the bank. So in a worst case scenario, again, if the business had to be liquidated, they would sell off all the assets and the bank would have first priority on all the cash from that sale until they're fully paid back. And only once they're paid back the full $15 million that they're due, the net funds are then going down to the junior and subordinated lenders. So the vendor note, in a worst case scenario, you buy the business for $20 million. A year later, it goes bankrupt and the bank has to sell off all the assets of the business for $18 million. So the business value declined by 2. Well, the first 15 would go back to pay the loan, and then the balance, the next $3 million in cash would pay out all the other deferred creditors, which in this instance would be $2 million, the VTB. So the vendor would then receive the net amount of funds. But right up front, the bank is going to have priority over everything. So the vendor has to sign a postponement and subordination agreement. And as part of that agreement, they have priority to say, even in a scenario where things get really tight, you're not allowed to pay interest. You're not allowed to pay principal to that seller lender. Therefore, you have to wait until we make sure that the business can stand on its own two legs in a worst case scenario. Okay? And then lastly, here's the other one, the postponement subordination agreement. So same thing of a shareholder loan. Say, for example, there are loans to the company from the shareholders to finance the acquisition, to finance growth and all that kind of stuff. Well, again, they are lenders to their own companies, and they have the right to pay those loans back. What the bank wants to see is that they have subordination protection to say, hey, in a worst case scenario, you can't pay that back until we get paid back first. So they want to draw the line in the sand and clarify any subordinated loans. We have priority to say, no, you can't pay that back until we get paid back if we feel that the situation is risky or the company needs that cash to stay within the business. And then the last one is a catch-all clause, which captures any other security that may be needed to support the facility. But these are the really common ones. I've gone through everything. Subordination and postponement agreements with third-party and other subordinated loans, personal guarantees, corporate and GSA charges, intercreditor agreements for the rules of engagement within multiple lender relationships, and then also an assignment of business and insurance policies. These are the very, very common security agreements, and each of these have separate legal documents when you're in closing that need to be signed and reviewed by the vendor. Now, the conditions of closing is like anything else. These are conditions that need to be fulfilled prior to the lender actually funding the loan. And again, because this is a term sheet, there may be more conditions of closings added to this, but up front, this is what the bank believes needs to be completed prior to funding the loan. The first is a catch-all. Most banks will include this: legal and tax due diligence. That means that the bank will retain their own lawyer to go through and ensure that there's no liens against the business, do corporate searches, check that the assets are wholly owned by that business, and that any commitments and promises that you've made are true, and those reasonable assumptions are support the loan. The next one is completion of all internal lender due diligence, including environmental, operational, and financial assessments. So lender due diligence is essentially the bank reviewing your loan application, confirming all the financial items, the operational items, and environmental if there's any environmental causes or concerns that may happen. The third is providing a detailed personal net worth statement for all shareholders. So any shareholders that are in the business, the bank wants to know about where do you come from, where do you get your money from? Are you able to put more money in if the business goes sour and we need net worth behind the company? Again, going back to skin in the game, do you even have the money to really commit to skin in the game and to stand by the company? So the bank is going to do their personal diligence on you. They typically ask for a credit card, maybe a photo of your passport, just confirming your address, and then they really want to see that personal net worth statement. So on every single deal, when you go to a bank or to a private lender, they will ask for your personal net worth statement to confirm how much money you have behind you. They're not only lending to your business, but in a worst case scenario, you may need to dip into your personal funds to continue supporting that business. Because in this instance, you've already provided a $5 million personal guarantee. They're going to look at that personal worth statement to say, do you even have $5 million to personally guarantee? Or are you just signing on the dotted line and not thinking about the risk? Now, number 4 is completion and registration of all security charges and other supporting documents. So in this instance, we go back to the GSA corporate guarantee and the PPSA charge against maybe equipment or assets or whatever the case is. So what this clause says is that, we will complete and register security charges against all of those assets to ensure that we are fully securitized. So this is a legal process of once you get the loan approved and it's signed off, they will actually register those liens so that, there's no confusion. Those are their assets that they can make a claim on in a worst case scenario. Now, number 5 is confirmation of an adjusted EBITDA of the business based on a quality of earnings. So what this means is that adjusted EBITDA is usually the financial benchmark they would use to calculate, whether you can support a loan. And so in most instances, this is not a clause that's required. But for M&A transactions or situations where there are a lot of normalizations to your profit, you're taking a lot of salary out, but you say, hey, you know what, I'm not going to take as much salary. I'm going to keep the funds in the company to service the loan. They really want to substantiate how much funds are actually available. What is the true profit of the business? What is the true adjusted EBITDA? And so what they do is they usually get a third-party accountant to provide a quality of earnings report, which is a third-party review of the financials confirming what the profit is. So it's really just a $20,000 report that the bank may ask of you to provide to substantiate the profit that you're borrowing money against. Number 6 is an equipment appraisal. So in this instance, say for example, you're buying a $20 million business, but there's equipment that you're buying with that business, and you want to borrow against that equipment. So the bank is making an assumption, and you've told the bank, hey, I think the equipment is worth maybe $5.75 million. Well, I'm going to get an appraisal so that I can support that and show you that there's real value there and that you can lend against it. So anytime you're lending against equipment, you want to make sure that you're getting an appraisal to confirm what the true value of that equipment is, because the bank is going to consider that in their analysis. So now when the bank is looking at that $15 million deal, going back here, there's a $15 million deal. There's 5.75 in equipment. There's another $2 million in the next point here in real estate. So $7.75 million is secured. Then I have a personal guarantee for 5. I almost have the full loan amount secured via assets or personal guarantees. So the bank is going to go through and make sure that they segment out all the value of the assets, the value of the goodwill, and understand how are they securitizing this loan. And so anytime there's real assets supporting a loan, they will get an appraisal to substantiate the value of those assets. Now, a satisfactory purchase and sale agreement. So in this instance, because you're buying a business, there's a purchase and sale agreement that needs to be signed between the buyer and the seller. The bank wants to bless that. They want to look at that and make sure from their legal point of view that you're not signing anything stupid that may put the business at risk. So they will always put in a catch-all that says, we want to bless your purchase and sale agreement if we're going to support your loan. Number 9, the sellers are to enter into a satisfactory employment agreement with standard non-compete and non-solicit agreements. So because this is a situation where you're buying a business, the sellers are usually going to provide a transition period where they're going to support the transition of the business to the new ownership group. And the bank wants to see that because they appreciate there's a lot of transition risk with M&A. And so usually what the buyer needs to do is they need to sign the sellers to an employment agreement for a period of time to transition the business. And the bank wants to ensure that those employment agreements are up to par, that there are standard non-compete and non-solicit agreements. Because the worst thing that happens is the buyer doesn't think about it. Maybe they're stupid and they buy the business and they don't get the seller to sign a non-compete. And then the next day, the seller, now with new fresh funds in their pocket, goes across the street and starts the same business and puts this business at risk. Well, from the bank's point of view, they want to prevent that from happening. So they're really the third pair of eyes, triple checking that the buyer has done the right thing and has signed the sellers up with non-competes and non-solicit agreements. So they will always have this out to say, if you're an idiot, we've gone through and at the final moment, we've looked at your legal agreements and you've signed some really crazy, wacky stuff that we're not comfortable in getting involved with, we can walk away from the loan because we know that you're taking on unnecessary risk. But again, these are pretty market terms, so I don't think there's a lot of deals where there's no non-compete signed. Usually sellers sign non-competes. Now, number 10, provide the most recent up-to-date financials. In most instances, banks are going to review your credit application based on your historical financials, but that may take a month to 3 months to complete. So really, during those 3 months, the business continues to perform and they need to get up-to-date financials. So usually the month prior to funding the deal, you want to provide the last months of financials to show up-to-date financials for the bank. Same thing, 11, you want to confirm that you have all the required insurance policies again, so that, you go back to here, the assignments are up to date, that they are fully insured. The lender in most instances wants to go out and see the business. So most lenders do a site inspection to confirm that the assets are real, that they're lending to a real business. Number 13, confirmation of the $3.2 million in equity. So what that means is that A, they're going to confirm the funds are real, that they're coming into the transaction. And in a worst case scenario, say for example, the day of the acquisition, they've wired the funds to you, but all of a sudden you can't put up $3.2 million in equity, the deal doesn't go through. You haven't fulfilled the condition of financing because they need to confirm that the 3.2 has come in. And sometimes, some buyers, they're really cunning, right? They'll try to play games and try to squeak by and put less money into the deal. So the bank wants to confirm that 3.2 has been put into the deal. And that's why they put that in there. And then lastly, here's another catch-all. So there may be other conditions that need to be added, but this is a very substantial, very detailed conditions of closing that you'd usually see for an M&A loan. Now, moving down to the covenants, this is critical, right? So usually there are financial and non-financial covenants. And the best way to think about a covenant is that it's a promise to either maintain to do something or not to do something. So for financial covenants, they're just really tracking the performance of the business. And usually covenants are tested on a quarterly basis. But for real estate where, there's less change on a day-to-day basis, maybe they test it on a semi-annual or annual basis. But especially for an M&A loan for $15 million, it's a substantial deal. The bank is going to be on you. They're going to test covenants on a quarterly basis. And so here, there are 3 covenants. There's a working capital ratio, which is essentially your current assets divided by your current liabilities. And that needs to be at least 1.1 and or above. So if it falls to 1.1 or it's 0.9, then you're in breach of the working capital covenant. Then you have a minimum debt service coverage ratio, or sometimes a fixed charge coverage ratio of 1.2. And usually banks have a DSCR minimum of 1.2 or 1.25. And so this is really, you're taking the net profit of the business plus any adjustments divided by the principal and interest of the loan and confirming that you have at least 1.2x coverage of cash flow relative to your obligations for the debt. Now, obviously, if you fall below 1, then your profit is not even covering your principal and interest, and therefore you're in breach of covenant. You can't pay the loan. So the bank always wants to see that there's a minimum of 1.2 with a little bit of a buffer of coverage servicing the loan. And then lastly, sometimes banks also want to see leverage covenants to make sure that you're not taking on too much excessive leverage relative to your debt, relative to your cash flow. So in this instance, they're looking at senior funded debt, which essentially means the amount of money borrowed from the bank and any senior lenders divided by the EBITDA or the cash flow of the business, and ensuring that it does not exceed 3.5 times. So in this instance, say for example, business does 1 million in EBITDA, really you can't borrow more than 3.5 million, or 1 times 3.5. You can't borrow more than 3.5 million in debt, because outside of that, that's you're exceeding your leverage cap covenant. So when you look at these covenants, my best advice for you as a business owner is you want to make sure that you're not looking just at the numbers, because most of the numbers are fairly market. You want to look at the definitions, and that's why I go to the definition slide here at the bottom here. This is probably the most critical section for a business owner to read to really understand how the calculations work for each of the covenants. But we'll get there when we get there, okay? So here are the financial covenants. Now there are the non-financial covenants, and typically these are restrictions. You can't take on more debt without our approval. There can't be a change in control without our approval. You can't dispose of assets in excess of $100,000 without our approval. You can't make any other acquisitions or sell any shares in your business without our approval, and you can't create other subsidiaries and other kind of affiliates to move assets around without our approval. So what the lender is trying to do is trying to commit the business owner to make sure that they're not trying to game the system to go around the security that the lender has put in place today, because they have the borrower, they have the guarantors, but maybe the business owner is trying to move assets out of that ring fence. And what they're trying to do is they're trying to say, well, you can't do that without our approval. So these covenants, if you do that, all of a sudden you're in breach of covenant, and therefore you're in default of the loan. So these are very stern rules. You can't take on debt, you can't change this, you can't move assets without our approval. And that's really the point of these covenants, to make sure that the lender is fully aware of whatever corporate matters that borrower is pursuing. Now, in terms of other covenants, there may be cross default, covenants, which essentially means, if you're borrowing multiple loans, if your other lender is in default, then we also are in default. So cross default means if one lender goes in default, all lenders go in default, because you can't have one lender pursuing legal charges and the other lenders are not, and they think everything's normal. So if one lender goes in default, everyone gets cross defaulted. And then as well, here there's combined management and salaries paid to the owner, John Smith, for this example, is limited to $250,000. So in extreme instances where there's tight cash flows or where the bank is giving a lot of money, they even will put in financial covenants that limit what shareholders are able to pay themselves or dividend out of the company. So in this example, this is not often. I'd say maybe in 10 to 20% of our deals we'll do this. But in this example, we wanted to make sure that John Smith understood anything outside of $250,000 in annual compensation. You needed to inform us, and we would have to provide consent to sign off and you paying such a large salary. And the reason why they typically do this is, say, for example, you buy a really big business, you have all this cash flow, and you start paying yourself millions and millions of dollars in personal funds, and the business starts to decline in performance. Well, we want to make sure that you're using those funds for corporate purposes, not pulling it out and buying cottages in Muskoka or whatever. So that's why there's typically restrictions on compensation in these larger transactions. Now, the reporting requirements relates to what you have to provide the bank on an ongoing basis for them to track the financial covenants. So if they're going to test them on a quarterly basis, you're going to need to provide the internal monthly statements for the business, and also a compliance certificate signed by the shareholder confirming I have calculated the covenants, I am on side, and I sign off that this information is correct. So on a quarterly basis, usually you will have to provide your last 3 months of financials so that the bank can calculate the covenants on an ongoing basis. In addition, at the end of the year, you have a more fully formed account and prepared financial statements, which you would also give to the bank within, in this example, 90 to 120 days, which confirms the annual performance of the business. So usually, because they're internal statements, the timing of requirement, you can submit your quarterly statements within 45 days because there's no one signing off on it. Whereas with your accountant prepared statements, it takes longer for the accountant to finalize those statements. Therefore, the bank is willing to wait 90 to 120 days for the year-end statements relative to the quarterlies. But this is required for all term sheets and will be seen. Now, in terms of fees, there are different lender fees. The first is the upfront, and the commitment fee is usually signed when you sign back the term sheet. So to really begin the underwrite and to begin the process of going through and doing the due diligence and getting the loan approved, the bank is going to incur costs and time that is going to need to be invested into the deal. So the upfront commitment fee of, in this example, $75,000 is paid upfront prior to the process being started. Now, in addition, there may be closing fees. Sometimes this commitment fee is paid at different stages. 50% gets paid upfront and 50% gets paid at closing or whatever. But in this example, there's one lender commitment fee of $75,000, and then in the balance here it says if the financing is declined. So even if we've invested all this time, but we were wrong, we didn't really do our due diligence and we messed up and the loan is actually not approved, then we will refund you that $75,000. But if you sign that commitment, that term sheet, and then you walk away from the deal while we've put in all this work, that's non-refundable. So in most instances, commitment fees are skin in the game for the borrower and the lender to go through the process together to get that loan approved. And so most lenders will ask for a commitment fee up front so that obviously they don't waste time if that borrower is going to multiple lenders and trying to get multiple term sheets and all that kind of stuff. So once you commit to us, you need to pay a commitment fee, and that's what this commitment fee does. In addition, usually on an ongoing basis, you have annual review fees. So when you put your annual statements and give the statements to the bank, usually they will do an in-depth review, kind of speak to you, maybe go visit you on an annual basis at your site just to check up on things. And usually there's an annual review fee of $5,000, $10,000, whatever the case is. And in addition, there may be quarterly review fees or there may be monthly fees. So there's different fees, but the fee section will outline really how that bank is going to charge you on an ongoing basis to monitor and maintain the loan. In terms of expenses, this is, it's always a shock for some business owners, but, the whole process of getting a loan approved, the lawyers and the consultants that are required for the bank to do their due diligence to securitize the loan and all that, that is at the expense of the borrower. So just to clarify, say for example, you go through the process and then you have to retain a lawyer to represent you to borrow funds. In addition, the bank has to retain the lawyer to draft up the GSA agreement, the corporate guarantees, the personal guarantees, all these kind of things. That all of those lawyer fees are covered by the borrower. So the bank, at the end of the process, will provide a bill back to the client that's borrowing the funds and say, hey, listen, our lawyer cost $25,000. You're going to have to pay that in addition to your own legal fees. So all legal fees, usually lenders will put onto the borrower so that they're paying for that. In terms of the assignability, so in this instance, the lender reserves the right in its sole discretion to assign, sell, transfer, or dispose of the rights in the loan. So what this does is, say for example, some lenders, they don't want to sit on that loan and keep it on their books. So they may provide the term sheet, underwrite the loan, fund it, and then sell it in the open market or sell it to another lender who would hold on to the loan until maturity. So most lenders will have an assignability or a syndication right, allowing them to pawn off that loan to another investor and borrower. The governing law is simply where the governing law is. If there's a dispute, then in this example, it'd be the province of Ontario and the rules within the province of Ontario. Confidentiality clause ensuring that you don't share this term sheet publicly, or that you don't openly go and disclose this term sheet to other banks. And it's a big no. Say for example, you get a term sheet from one bank and then you go to your second bank and show them that term sheet, because again, the confidentiality clause would protect against that. And then the definitions section. So we kind of talked about this during the financial covenants. So definitions are critical, because this is actually where a lot of the time risk management will spend their time in clarifying and tweaking these terms. So one section you'll see is combined. So if you go back to the financial covenant section, you'll see the minimum combined working capital ratio, the minimum combined debt service coverage ratio. And what that means is that combined is all combined accounts of the borrower and guarantors. So it's not only the borrower where the loan resides, but the guarantors. So the holding companies, the subsidiaries, everything. So the bank is looking at the corporate ring fence, again, that all of the companies related to the loan, and combining them all together to calculate, is the group as a whole healthy? Are they on side with their working capital, with their debt service coverage, and all that kind of stuff? And so what ends up happening is most business owners forget that maybe one of their subsidiary companies, they move a lot of funds around, they dividend them out, and it's like, well, no, the debt is on the borrower balance sheet. They don't care about the guarantor. But at the end of the year, when they calculate the covenants, they're calculating the covenants and incorporating the funds that were moved out of that subsidiary company, which results in that borrower being offside. And that's what happens oftentimes. Like business owners forget about the combined definition. Combined includes the borrower and the guarantors. Don't forget that. And then these are the covenants. So the debt service coverage ratio, as I kind of talked about before, is really the sum of the net income, deferred taxes, amortization, and depreciation, which is non-cash, interest on the long-term debt, and then any non-recurring or normalizations, divided by the sum of the interest and the principal payments over the last 12 months. So it's really the calculation explaining how the covenant is being calculated. And so you really want to reread this a few times just to understand and remember that calculation. There's the EBITDA. So how is EBITDA calculated? Again, because there's going to be a senior funded debt leverage covenant, and EBITDA is a term used in that. So understanding how that goes. In this instance, maybe instead of a debt service coverage ratio, there's a fixed charge coverage ratio. So here's the fixed charge coverage ratio definition. It's very similar to the DSCR, except that instead of it's stopping at net income plus depreciation amortization, there's also a cost of capital expenditures. So here, the big difference is instead of B, the sum of all regular payments of principal and interest over the last 12 months, it's the sum of all regular principal interest over the last 12 months, in addition to plus unfunded capital expenditures plus distributions to shareholders. So if you use cash to fund a CapEx purchase, or you dividend out funds, that is deducted against the amount, and all of a sudden, that's an additional burden for the fixed charge coverage ratio. So your denominator increases, and in a way, it actually puts you offside. So I've seen a lot of clients when I was at the bank where they dividend out a lot of money, and they didn't think and they didn't read that there's a fixed charge coverage ratio, which includes those distributions. So that $1 million gets added to B, and all of a sudden they're offside on the fixed charge coverage ratio. So again, it's really critical to read the definition when you're going through this. And then senior funded debt, in this example, it means all funded debt that has not been subordinated to the obligations of the borrower and the lender. Okay? So again, key definition is important. And then the last section is really, in most instances, an offer, the term sheet. It has a time period of 2 weeks or 3 weeks in which it's active. And if you sit on that term sheet, or you come back to the bank after a year, you can't pull an old term sheet and say, hey, I want these terms again, because the acceptance period has lapsed and it's expired. So most instances, when a term sheet is presented to you, it lasts for about 2 or 3 weeks, after which terms may have to be reset if you want to revisit that term sheet again. And then that's really it. There's the borrower. If there are multiple guarantors, there are multiple signing authorities that need to be signed. But in most instances, there's a borrower, there's a guarantor, and you sign for both if you're the owner of the company. But that's the in-depth overview of a term sheet. There's a lot here. If you do have any questions, do please comment on the video, or you can reach out over LinkedIn and connect with me, and I can kind of help you walk through a term sheet. But if you have any comments or questions, please comment below, and please like and subscribe to the channel for more of this video. Hopefully this is helpful for you guys, and have a wonderful day. Take care.